So welcome everyone. You're probably wondering why would anybody want to do a book, more or less a talk on divorce and taxes? And it all started because I realized that I had clients and friends and family that were making mistakes. And I really couldn't blame them because if you really think about it, divorce attorneys are who you go to get help. But in reality, divorce attorneys aren't tax experts. They're actually family law experts. And so there's an issue there when you go to them because you expect them to be able to help you, and they can help you with great family matter things. But um, then when it comes to the tax consequences, they don't necessarily know all the answers because it can get very complicated. I mean, I spend over 50 hours a year doing continuing education on taxes. So, they have their own family law stuff they need to do their continuing education on. So we can't expect them to know everything. What also I saw is with these friends and family, the mistakes being made was that they were putting themselves in a situation where as a couple, they were spending extra money on unnecessary taxes. And divorced people need money, right? They're going from one household to two, and that's always more expensive. So I'm Beth Logan, and I'm an enrolled agent. That's a federally licensed tax professional. So a CPA is state certified, and an enrolled agent is federally licensed. I have actually written 3 books on divorce and taxes. I've done a bunch of articles for national publications, and I've also been quoted in several articles at Forbes, Consumer Reports, Yahoo News, and some others. Some people feel like this, right? It was lovely before quarantine, and now you are sick of that partner. So I think there's going to be a uptick in divorce because any tensions have been just exaggerated in this. And I want to make sure that people don't make mistakes that end up causing them to have more financial hardship. I am going to try and be a little lighthearted about this. I know it's a difficult subject. It can be considered a dry subject, so that's why I want to be a little lighthearted, but I know it can also be stressful. So I apologize if the lightheartedness just exacerbates your stress, but it is something that it's a tough subject because it's a subject that people don't know. It can be stressful, but at the same time, we don't want it to be too dry. So what are the 3 biggest mistakes? I'm going to start here, and then I'll briefly review some other stuff, but just in summary, some people file jointly when they're going through a divorce. They think they can claim head of household just because the decree says that they can claim little Johnny. And they make emotional decision on assets instead of a fiscally responsible decision. And that's very common. I mean, we often make emotional decisions at emotional times. And sometimes we need to step back and look at them from a more fiscal standpoint. And part of my lightheartedness is I've taken some famous quotes on divorce. And this one's from Johnny Carson. The difference between divorce and legal separation is that legal separation gives you time to hide your money. It's kind of a funny line unless you're the spouse that it's being hidden from. And this is one of the problems with filing jointly. In general, when you file a joint tax return with your spouse, you actually usually save money than if you file separately. The problem is when you file a joint tax return, you are signing to shared responsibility. And when I say shared responsibility, I don't mean 50-50. I mean 100-100. Both of you are 100% responsible for the tax return. So now, think about that. There's a reason you're divorcing. There might be stuff that one spouse is hidden from the other. So do you really want to file jointly? And that's a very, very important question. And as you see here, this quote that's on the second sub-bullet Under penalties of perjury, I declare that this tax return is true and correct. Under penalties of perjury. So that is, perjury is a criminal, is criminal. So if you sign this and you're wrong, it can be, you can be considered having committed a crime, where your divorce decree is a civil court agreement. And your divorce decree, one of the attorneys may say, hey, judge, they should file jointly because it'll save them money. Well, they can say all they want in a civil situation. They cannot force you to sign a document that by signing it has you committing perjury. So they cannot force you into a criminal situation in a civil contract. So it's very important that both spouses, if they choose to file jointly, trust and fully understand what they're signing. Now, you're saying, well, but married filing separately is going to cost so much more. You might not have to. If the couple has separated before July 1st and there's a dependent involved, so they are not living together, they cannot live in the same household. So let's say one spouse moves out in May and there's children involved. One or possibly both spouses may be able to claim head of household instead of married filing separately. And so that would be more advantageous than married filing separately and safer than married filing jointly, because you would be filing just your information. Now, I say this, but in community property states, you still have some obligation to be sharing the information and splitting the return, but at least you're protecting yourself from the other person's tax liability. And it's very, very common, frighteningly so, that divorce decrees say couples must file jointly, and therefore they feel like they must file jointly. Please make sure yours does not require you to file jointly. It must require the sharing of documents, but not dictate how to file. And then you and your spouse can work together, if you can, and actually make a reasonable decision on whether you're both comfortable. If you both work W-2 jobs and have some 1099 interest, file jointly. But if one of you has a business, start asking questions. If you don't have access to the books, if you don't feel comfortable with the numbers, if you think that maybe there was bartering going on that wasn't included, then you want to file separately. You do not want to have a long-term tax issue because you signed something that you didn't really understand the numbers that were in it. So that's the first big mistake that happens. So hopefully this won't happen to you. This is one of my favorite quotes. I've always loved this one. When I meet a guy, I ask myself, is this the man I want my children to spend their weekends with? And those children, that is where people also make a bunch of mistakes. They get emotional, they want to protect their children, and they get in arguments over who's going to have full custody and who's going to have partial custody, and then the divorce decree is written and it says, and I tend to use the names Chris and Drew because there's no gender issues. So let's say Chris gets the children 4 days and Drew gets the children 3 days. Boom. Does not matter what's in the divorce decree. It does not matter that the divorce decree says Chris gets the children 4 days, but Drew gets to claim the child every other year. What does that mean? In reality, it's a civil contract, your divorce, and it means nothing because the IRC, which is the tax code, which is, by the way, written by Congress, the IRC says that the only person who can claim head of household is the custodial parent. And that's the parent that the child has lived with for more than 50% of the time and provides 50% of the support. Now, if Drew is paying child support to Chris, and then Chris puts that child support plus other money into running the house, paying the mortgage, paying the electric bill, buying the food, that child support counts as Chris's. If Drew, let's say Chris has the children 4 days a week and Drew has them 3 days a week, but Drew pays the mortgage and the electric bill and some of the food, then Drew is doing 50% of the support and Chris is doing 50% of the time, and neither of them are the custodial parent in the sense of claiming head of household. So it gets a little warped here. I know you're thinking that makes no sense. Somebody has to be the custodial parent, but this is the law as Congress wrote it. Now, if you can claim head of household, then you can get the dependent care credits. That's the credit for paying child care. But it's only the head of household that can get it. Of course, only if the head of household is working. Now, this can be a problem because some parents are taking benefits through work to pay the child care, but then they're not the custodial parent, and then that benefit becomes taxable again. It can also be a problem if you're switching back and forth, if it's 50-50, so there's 365 days of the year. So 1 year, one parent is the custodial parent, and the next year the other one is, because the number of days, and so you alternate each year. Then some years you can claim the dependent care credit, and some years you can't, even if you're sharing the cost right now. It can get very complicated. The only thing that claiming a child can mean on the divorce decree is for child tax credit, because that can go to either parent. But here's the trick. It doesn't matter what says in the divorce decree. The IRS requires that Form 8332 be filed by the person claiming the tax credit and be signed by the custodial parent. Otherwise, they cannot get the child tax credit. Now, the child tax credit is this $2,000 credit per child who's 16 or under. Once you turn 17, it's only $500. I know it's weird. It's only $500. I joke around because they think Congress somehow thought for some reason that 17-year-olds were cheaper than 16-year-olds. I don't know. I can't answer it. But you have to look to the law, and the law says these are the rules for head of household. Only head of household can get dependent care, and you can only take the child tax credit if you're the non-custodial parent and have received the 8332 from the custodial parent. So what does this mean for that divorce decree that says you're claiming the child in even years? You need it to say that this spouse is claiming the child in even years, and if that spouse is not the custodial parent, it should also say the custodial parent is required to provide Form 8332 for all those years. And that's very important. The third biggest mistake, Zsa Zsa Gabor, she got a couple of funny lines. He taught me housekeeping. When I divorce, I keep the house. I think somebody also asked her if you keep the ring. And she said, no, you return the ring, but you keep the diamond. So she was out to keep assets in divorces. And that's the next one, dividing assets. There's a lot of issues about dividing assets. The first one is actually not a tax one, but I think everybody should consider it. Before you say, I really want to keep the house, I'm the custodial parent and I really want to keep the house, you need to really think if you can afford to keep the house. You might have a car and you might think, well, we bought this nice car, but I want to keep it. But it could be a two-seater and you have 2 children. it's not a practical car. Can you afford a second car that's practical that lets you carry your children around? There's a lot of issues. So after you figure out what assets you can afford, the question is, what is the tax implication? And this is something a lot of people don't think about. Let's say Chris has a bunch of stock and Drew and Chris decide to split the stock. So there's a bunch of options. Chris can give the stock to Drew as stock or sell it and then give the cash value. There's a very important difference here, because if they sell it when they're married and they're doing a joint return, then it shows up on the joint return and they share in the tax cost. If they're not doing a joint return and Chris sells it, then it's on Chris's tax return and Chris's tax rate. If it's given to Drew as stock and then Drew sells it, it's at Drew's tax return, at Drew's tax rate. Why does this matter? Well, let's say you have $100,000 in cash and $100,000 in stock. Cash, there's no tax consequence. The stock, let's say, has long-term gains of $30,000. Well, if Drew's income is in the lower two tax brackets, 10 and 12%, and that stock doesn't push it above that, the gains, then Drew's tax on that stock is zero, because long-term capital gains in the lower tax brackets is zero. But Chris's income may be much higher. And so if Chris sold that stock, it could be a 15% tax hit. Well, now instead of $20,000 of gain, it's $20,000 of gain minus $3,000 of taxes, plus state taxes, by the way. I'm not even counting that one in here. So I've already dropped the value by $3,000. So maybe it should go to Drew, and then Chris is getting cash, Drew is getting stock. They're both worth $100,000. That's even. But if it goes the other way, in reality, Chris is only getting $97,000 minus whatever the state tax rate is, and Drew is getting $100,000. So you need to be careful here on how you split these assets. The same thing with the home. Couples have, one spouse has taken the home and then went to sell it, and as a married couple, you can actually write off the gains up to $500,000 on the home, but as a single person, only $250,000. So I had a client who took the home and then a couple years later decided it was too much work, went to sell the home, and they already had a gain of $300,000 in the home, and now she was paying taxes on $50,000 worth of gain. Where if they had sold the home when they were married and then each bought a home, they wouldn't have paid taxes on any of that gain. So there's a whole bunch of different things that come into play. And this is on IRAs, Roths, cash, homes, investments. All these things have different values and different pre-tax value and post-tax value. And it needs to be considered if you actually want to allocate the assets, not only in a post-tax favorable way, but also allocate them so that the two spouses end up with more money and the government with the least, as opposed to what happens often is they split it evenly and the government ends up with more money than they would have had it been split in a more tax advantageous way. And the last asset I want to talk about is the business. People say to me, so how should we divide a business? And I think it's kind of like, as they say, dividing the baby. You really can't. You can't just say, I'm going to divide this business, because you could essentially it's not like you have two half businesses you put together. I mean, maybe you do. If you own something like GE, where you have jet engines and you have light bulbs, then you could split those two sub-businesses out. But most small businesses aren't like that. So what happens? A sole proprietor means that only one person owns it. So if it's a sole proprietor, it is owned by whichever spouse owns it, unless unless it's a transfer or sale. Okay. If it's, and that also, usually in that case, the sole proprietor is the one doing the work. So it's silly to try and take it away from that person, because then there's nobody doing the work. So for instance, I'm an enrolled agent and I have a tax business. If my husband took my tax business, he's not an enrolled agent. What would he do with it? It would really not be a business anymore. So the better thing is to say, what's the value of that? And then what assets or how can future payments be made to offset that value? And especially since a lot of people who have small businesses have built it up with either initial financial contribution from the couple, and time, and a lot of times couples help each other. So you need to look at that. If it's a partnership, then it follows the partnership rules and agreement. And if it's the two spouses who own the partner, again, you got to look at how could you even split it? Do they have to work together? Is one person the worker and the other one's like the back office? Then maybe the person who actually does the work keeps the business and the back office person gets an equivalent of the salary. But then they're still working together. That might not work. They may need since they're divorcing, maybe they have to hire somebody. That person has to go get a job. You have to figure that out. But you also have to look at the partnership agreement, because that's a contract. Now, a corporation is a corporation, whether it's an S Corp or C Corp. You own a certain number of shares, that's what you own. Some people ask about LLCs. An LLC from a tax status is not a tax entity. LLCs are treated as sole proprietor, partnership, or corporations. So there's lots and lots of things to consider here when looking at a business, and it depends on how the business functions, the value of the business. Can you even assess the value of the business? How much are each of the spouses involved? What is the legal entity? What's the legal contract? Like if it's a partnership, or then there's a partnership agreement. All these things play into it. I've also seen sole proprietors, like I said, where one owns it, the other one, they both work at the job. That gets a little tricky and dicey. And you can't just say, well, I'm going to fire you. That wouldn't be the right thing to do. They may need to leave because of the relationship, but they need to then be compensated for that business that they've helped the other spouse build. Now, those are the three big mistakes that people make when doing divorce, but I'm going to go through what I created as the checklist, which was actually the beginning of the book. I started just giving clients and family checklists, and then I decided they need a little more information. So, I mean, it's 90 pages, so it's not like I give them a lot of pages, but I went through these basically 15 things that people have to consider. Copies of tax returns are required, actually by law. Both spouses have to get a copy of the tax returns for at least the past 3 years. It's really important people get that. But there's other financial information and documents that need to be shared between the parties. And it's, bank account numbers, investment numbers. You basically have to keep your financial books open as you go through divorce. Once you're through the divorce, you take yours, your ex-spouse takes theirs, and then you can kind of, I'm going to say, close the door on that and not share it, unless in the divorce decree you have to tell them each year like what you make, or sometimes there's especially with the business, you have to tell them what the business profit is because of the amount then that's given as alimony or child support or whatever. But in general, anything before the day of the divorce has to be shared equally, and spouses should both make sure they have documentation. This is also important because of those things called verification questions, which some of you have probably heard of. You've probably had to deal with them. They ask things like, in 2018, you paid off a car loan from which of these banks? And then it'll list 5 banks or 4 banks, and the other one says none of the above. And you have to answer. Or you had a credit card with this bank, what type of credit card was it? So it'll be questions like this. And you're thinking, okay, why do we need to know this? These verification questions go back as far as 10 years. And what often happens in couples is one of them is the financial person and one isn't. And that one knows the answer to all these questions. And the other one then gets divorced and needs to do something. And they say, okay, well, we need to verify that you're who you claim you are. So we're going to ask you these questions. And that one says, I never did the finances. I don't know. So it's important that that kind of stuff is shared so that you later have the answers to these verification questions. Future documents need to be shared. There are documents that come the next year, right? That may have your name on them. Mortgage payments. So it may have been in one person's name and then, or in both spouse's name, and then when they divorce, one couple gets the house and the mortgage payment, but that original mortgage documents are in both names, and you need to share them. That's just one of many. There's 1099-Gs, which is the refund from the previous year. There's health insurance information if you went through the Affordable Care Act. In Massachusetts and a couple other states, there's also healthcare information that's required by law. So these kinds of documents that may come in the future need to be shared. The next one, what filing status are you allowed to use? I talked about this briefly, but you need to know what everybody's doing before the divorce. So if you separate in March and you still haven't filed your return from the year before, and you decide, you say, I'm filing separately. Well, you need to tell your spouse that. And the other thing is when you file married filing separately, if one of you itemizes, both have to itemize. So you either both itemize or you're both standard deduction. You need to know what the other one's doing. So I know you're thinking I'm divorcing this person because I'm done with them, but there are some things you still have to finish. Who can claim which children for the head of household and child credit? You need to make sure you understand that, and you need to make sure if you're taking the child credit and you're not the custodial parent, you get that form 8332. Are there carryover tax issues? Yeah, there's a lot of these. There's more than people realize. The first one is the refund. So if you got a state tax refund, and this is less of an issue now after tax reform, but if you got a refund, somebody has to potentially claim that refund on a future income tax return. And claiming that refund, you know, if you itemized, you could, let's say it's $3,000 refund. Do you split it between the two of you? Does one person take the whole refund and put it on their tax return as income? It can make a big difference. Other issues are if you have carryover losses, if you have from investments, it usually goes to whoever had the investment, but everybody needs to make sure they understand who has what and what the losses cover. If there's rental property with losses, if there's NOL, which is net operating losses, it's generally losses, but it's not always. There's, if you had alternative minimum tax, there are credits that can carry over. So there's all sorts of things that could carry over, and that needs to be considered. And there's now with the, it's 199A, the qualified business income deduction. There are times when different things combine to allow for that deduction or losses, and you need to understand how to break them up. I mentioned the health insurance forms. If people have joint health insurance, there might be information, and if they're on the Affordable Care Act together and they remain on it, or even if they don't, there's some information you need to understand, not only how it's going to be divided in the future, but how to handle it on your tax return. And you can actually give all of the premium credits to one spouse, and that can be advantageous if that's a lower income spouse. Retirement assets. These are important because if you have a 401k or 403b or certain other ones, it's not true for IRAs, but those type of retirement assets, which are run by like your employer, you need to have something called a quadro, qualified domestic relations order. And you need to have this completed and presented to whoever's handling the 401k before the divorce. Because let's say, Fidelity's a big one. Fidelity has your spouse's 401k and you're supposed to get 50% of it. So you need to give that quadro to Fidelity or Edward Jones or T. Rowe Price or whoever. Give it to them, and then they'll come back and say, yes, it's okay, and we can give you this 50%. If you wait until after you're divorced and you find out there's an error with the quadro, you can't go back and get it fixed. You've now lost access to that money. So you need to do that first. I mentioned dividing assets in the most efficient way. Alimony, it's less of an issue now because you can't deduct the alimony paid, and so you don't have to claim it as income at the federal level. But that's not true at the state level. Some of the states didn't change it. So you need to understand that. You need both parties to understand when alimony is being decided on, how it's being handled tax-wise, because it's basically a different amount of money after tax than you might think. If I'm getting paid $20,000 in alimony, and now I find out that I have to pay the state 5% of that, then I'm really getting $19,000, but I had reduced it to $20,000 because I thought there were no taxes on it in the agreement. So you need to make sure you understand that. I know you're thinking, all I want to do is burn the marriage certificate. Please don't. Keep a copy of your marriage certificate and your divorce decree. Both of you should have one. There's a bunch of different reasons, but one of the big ones is if you've been married 10 years and you have that marriage certificate and divorce decree, you then have the right to get Social Security based on your ex-spouse's income. So if you were a stay-at-home parent taking care of kids, this might be really critical for you later. Do past tax returns need to be amended? And you're thinking, what? If you get an annulment, then you were never married. And if you filed married filing jointly or married filing separately, you need to go back and amend those returns for single. And if you did married filing separately and you got an annulment, you may be getting a refund. You may be getting a refund for married filing jointly, but generally not. It's usually fantastic though if you, I shouldn't say that generally not, it just depends on the situation. But it does have to be amended technically. I'm not saying everybody does what they're supposed to do, but you could be getting money back. Watch out for name and address changes, especially with tax returns. You need to make sure that you've provided all the right information. You can contact the IRS at any time, and even the state DOR, and change your name and address, because you don't want to move and find out that the IRS is sending letters to your old address that are saying, hey, we've got an issue, because all that does is make the issue snowball. So you want to know right away. But there's a lot of places where you're going to need to change your name and address. And then depending on the situation, you may be able to claim injured or innocent spouse. It's not as easy as you think, but there might be situations where you'll be able to claim that, and and you need to know, if there's past history of problems, what your options are. So that's just a quick rundown. There's a bonus check. This wasn't in there at the time because the IRS changed this form afterwards, but it is worth going back and redoing your W-4 to have different withholdings than before you were married, because your whole tax situation is different. So you should adjust your income withholdings. So that's a little bonus check with this presentation. So that's my presentation. I don't see any questions right now, but feel free, please, in either the chat box or the question box to answer them. I want to first thank the Better Business Bureau for this opportunity to do this. I hope that people don't make mistakes. Well, first of all, I hope people don't have to go through divorce because it's stressful. But if you do, I hope this is helping and that you will make better decisions in working with your divorce attorney, or even if you're not working with a divorce attorney, and making better financial decisions as you go through it. You can find more information about my book at divorceandtaxes.net. And actually, you can find more information about me at kozlog.com. And I'll take any questions if there are any. And seeing none. Oh, I have a question. Sorry. So the question is, what are the advantages of filing married versus filing single? You are actually, it's not, you don't even have a choice. If you are married, you have to file either married filing jointly or married filing single, or if you have been separated since before July 1st and living apart since before July 1st, then you can do head of household. But the only way you can file single is if you are divorced, or in some states, if you have a certain legal separation, it's considered single. In some states, a legal separation is considered married still. So it depends on the state and the way the legal separation is done. But if you are married and the divorce is not final, in general, you must file either married filing separately. So the question is, so what are the advantages of married filing jointly versus married filing separately? If you're married filing jointly, you can take a deduction for student loan interest. You can take some other deductions, I believe, dependent care. There are some other things. There are some limitations on different credits and deductions for filing, that if you file married filing separately, there are credits and deductions that you are not allowed to take that you are allowed to take if you're married filing jointly, which is why generally married filing jointly is cheaper. The big issue, though, as I said at the beginning, is if when you sign that tax return, it's perjury if you sign it and it's wrong. And you are 100% responsible, even if the mistake is because your spouse withheld information. Now, again, you may or may not be able to do innocent spouse or injured. They're two different things, innocent spouse, but it is it's a higher bar to jump to claim innocent spouse, and it's a lot of stress. So it may not be worth all the letters saying, hey, you owe us money. So it's very important that you understand everything that's in the tax return before you sign it. And if you're not comfortable with it, then you just file separately. I'm looking to see, I don't see any other questions. So I want to